All right, let's dive into the latest quarterly report from a giant in the semiconductor world, On Semiconductor. We're not just going to look at the numbers on the page. Nah, we're going to uncover the story behind them. A story about a changing market, some really tough choices, and some huge bets on what's next. Let's get to it. So here's the question at the heart of all this. When the market suddenly turns on you, what do? On Semiconductor's latest quarter gives us a fascinating, real-world look at how a massive tech company tries to navigate some pretty choppy waters.
And here are those choppy waters, plain as day. Look at this. Revenue for the third quarter took a pretty serious hit, dropping 12% from the same time last year. That's a fall of over $200 million. For a company of this scale, that's not just a little dip. That is a major signal that the whole market has shifted under their feet.
But here's where the story gets even more dramatic. Revenue fell 12%, right? But look at the net income, the actual profit. It absolutely plummeted by over 36%. This isn't just a slowdown anymore, this is a massive blow to the bottom line. And it explains why the company felt it had to make some very big moves, and fast. So what's going on here? Did the company just mess up? Well, the report is pretty clear. This isn't about some internal blunder. The problem is coming from the outside. After years of supply chain madness and crazy demand, things are finally starting to cool off. The market is hitting the brakes. And On Semiconductor is sailing right into those headwinds.
And you don't have to take my word for it. Management tells us exactly what those headwinds are. In their own words, the drop is all about a decrease in demand from two very, very important sectors, automotive and industrial. And these aren't just small parts of their business. They are the absolute core of it.
And this chart, wow, it shows you exactly why that slowdown is such a massive deal. Just look at this breakdown. The automotive sector alone is more than half of their revenue. You add an industrial, and we are talking about over 78% of their entire business. So yeah, when car companies and factories slow down their orders, ON Semiconductor feels it big time. So, faced with that new reality, did the company just sit back and hope for the best? No way. They responded with a huge, decisive, and frankly, a pretty painful strategic pivot. They're calling it a realignment. The official name is the 2025 Manufacturing Realignment Program. Now, the goal here isn't just to cut costs for a bad quarter. It's way bigger than that. It's about completely reshaping their manufacturing and their overall strategy to line up with where they think the world is going long term. But a change this big comes at a real price. The plan includes cutting their global workforce by about 2,400 employees. It's a stark reminder of the very real human cost behind these huge corporate strategy shifts. And the financial cost? It is just staggering. So far this year, the company has taken on over $600 million in charges that are directly tied to this realignment. This isn't just trimming the budget. This is a fundamental and incredibly expensive teardown and rebuild of the company's structure. So where did most of that cash go? Well, the single biggest piece of the pie is this, a nearly $500 million charge for something called asset impairment. Most of this is for manufacturing equipment that the company has basically decided it doesn't need anymore. But what does asset impairment actually mean? Okay, asset impairment sounds super technical, but the idea is actually pretty simple. Think of it like this. Imagine you have a giant factory machine, and on your accounting books, it's valued at $10 million. But because of your new strategy, you know you're not going to use it, and you can only sell it for, say, $2 million. That $8 million difference, that's the impairment. It's the company getting real and saying, okay, this asset is not worth what we thought it was. And it wasn't just the big factory machines. They also had to deal with all the stuff they'd already made. They took another huge charge, over $235 million, to write off inventory that's now considered extra or just plain obsolete under the new game plan. A lot of that hit their intelligent sensing group. Now, at this point, you're probably thinking this is a pretty bleak story, right? All about cuts and write-downs. But that's really only half the picture. While one hand was making all these painful cuts, the other was getting busy making some really interesting investments in the future. This slide just captures that two-sided strategy perfectly. On the left, you've got all the tough medicine, the layoffs, the write-downs, but on the right, you see these really confident, forward-looking moves, buying other companies for their tech and buying back their own stock. It's a classic case of taking some short-term pain for what you hope is a long-term gain.
So let's break down those bets, because they're really smart. First, they snapped up some silicon carbide tech from a company called Qorvo. This is a direct play on the absolute explosion in AI data centers, which need super efficient power chips. Second, they bought some V-Core power tech from Aura to make their whole power management lineup stronger. These are not random buys. They're very targeted moves into markets that are growing like crazy.
And maybe the biggest signal of confidence of all is this. The company has spent almost $1 billion this year buying back its own shares. When a company does that, it's basically management investing in itself. They're telling the market, hey, we think our stock is a bargain right now, and we believe our best days are still ahead, even with this downturn. Okay, so we've seen the market slow down. We've seen the drastic response, and we've seen the big bets on the future. So let's step back for a second and put all these pieces together. You know, when you look at it all, the story of this quarter really plays out like a 3-act play. Act 1, the market slowdown, where their biggest customers just stopped buying as much. Act 2, the painful pivot, where they launched this huge, expensive plan to adapt. And Act 3, the future focus, where at the same time, they were pouring money into hot new tech and betting on themselves. And that leaves us with the big, unanswered question, doesn't it? The company made a bold, expensive, and difficult choice to completely reshape itself. They're trading a whole lot of short-term pain for what they believe will be long-term strength. And now, really, all we can do is watch and see if this painful pivot was the right move.